There's a very, very fine balance between combined ratio and the investment income and the actual risk that they face. So carriers are really, really trying to thread the needle to get this risk reward analysis just right.
What is a residual market, and what are some examples of them?
There's a misconception around kind of what insurance carriers exist. Oftentimes, a lot of insurance markets that are really overlooked are residual markets. Now, these are kind of considered the markets of last resort, which doesn't necessarily mean they're going to be the most economical. But what it does mean is that if you really need something, you're in a tight space, and you're like, hey, the best we have out there is X, or maybe we can't find anything, then there's always going to be, or not always, but in a lot of times, there's going to be a state option. So with California, we have Cal Quake to look at earthquake. You have options like the Cal Fair program, which will provide property and casualty insurance for businesses. And they've actually started to increase some of their limits so that you now can get higher limits as a business owner. You also have options like the state fund for workers' comp, which is going to step in when you are a new business and you don't have an experience mod, or in the situation where you have a very high experience mod and historically you're in an operation that maybe has a lot more claims than another industry. And you're like, hey, it's very hard to find workers' comp insurance. It's very, very expensive. And what you can do is then look at a residual carrier like the state fund. Now, there's all these different options across the country that kind of exist. So in Texas, you have the Texas State Wind Fund. Florida has their comparable group. And what those markets are really there to do is make sure that if you're in an area that historically has not been able to be insured, because whether it's a catastrophe or fires, that's your kind of market of last resort. And the weird thing is oftentimes these can be priced appropriate to your risk. It's just going to take a little bit more work for someone to go in and put it in manually to be able to get the quote. And the timing may take a little bit longer, but oftentimes the pricing isn't that bad.
What are some exclusions an insurance adjuster should look for?
What we often come across is when groups are purchasing new insurance policies and they're really looking to do a comparison and say, this is what we have now versus what we're kind of looking at. Price is just one kind of factor we're considering. But we also have to consider, particularly on the liability side, we have to look at what's not being included in this coverage. Now, some of the ones we often see are going to be abuse, right? Which sometimes this can be kind of molded with the sexual abuse and assault. And sometimes those can be separate exclusions where you have an exclusion for abuse. You can also have an exclusion for any kind of assault and battery. You can have an exclusion for habitability. You can have exclusion for animals. You can have an exclusion for infestations. You can have an exclusion for mold. You can have exclusion for construction activities, which would then would not allow for any kind of third-party liability suits if you had over a certain amount of construction or any type of construction at your site. So these are items we just want to be hyper aware of when we're looking at the insurance program that you have and saying, hey, if something does happen, are we adequately covered? And are we going to even be covered at all? And those are kind of some of the factors that we want to really balance and look at when we're comparing insurance policies.
How do insurance companies make money?
I think there's a little bit of misconception out there around how insurance companies make money, right? I think the general predisposition is to believe that, right, someone pays insurance and then all this money is kind of just utilized, it just sits there, right? And then the insurance company uses that as their profit. And things from the broker side and from the underwriting side. And so I just hear a lot of these misconceptions in the market. What they're really measuring is they're looking at their combined ratio, which is their underwriting profitability, and also their investment profitability. Those are two factors. And the combined ratio is really measuring based on their expenses from their losses, based on their overhead, based on contingencies they have to pay brokers. And then you look at the amount of premiums they brought in. You're doing a P&L analysis and saying, hey, are we for every $60, $70, $80 that we spend in overhead and all these expenses, what's that difference between the full dollar that we bring in insurance premium And the total goal for a combined ratio from an underwriting standpoint is really to try to get to, anywhere from 95 to 90, you're kind of best in class. And what that means is that essentially for every dollar of premium that you're writing, you're essentially making 5 cents, right, in net profit. And best in class, you're making 10 cents. Now, these are the best in class. But the average insurance company, because of the way catastrophe losses are impacting them, the average company, unless you add in the contingency from the investment returns, which means the dollars that they use in terms of premiums and they allocate out into the market in terms of very, very stabilized insurance and very stabilized investments, that those dollars can then be used to offset some of that loss or make their profitability better. But really, in the short term, insurance carriers have really been relying on this investment return to really bolster and create any kind of profitability at all. And you may think, well, wait, the market has been performing really, really well and the interest rates are high. And some of that, as the interest rates get better, yes, that does help insurance carriers that are providing P&C insurance companies. But at the same time, they're very, very restricted on what kind of investments they can actually use those dollars to. CDs, treasuries. But this is very stable stuff that can be liquidated very quickly to meet reserve needs if there are some kind of large losses. Now, if you look at who's investing in the real estate, those are going to be the more pension funds and the life insurance policies and these policies where there's a large accrual around the insurance and they're not utilized or paid out every year. So therefore, there's a very, very fine balance between combined ratio and the investment income and the actual risk that they face. So carriers are really, really trying to thread the needle to get this risk-reward analysis just right.
What is the excess surplus market, and what are the implications of that market?
With a lot of my clients and just clients in general, buyers out there of insurance, moving from a direct retail admitted market into an excess surplus market, I wanted to make sure that I did a video to capture kind of what the differences were. All right, and historically, what the differences have been, and this doesn't always hold today, but this is, by vast majority, this is going to be true. The excess and surplus markets are going to be spaces where the direct admitted carriers don't necessarily have a filed plan in that state or within a conglomerate of states to meet the needs of that particular buyer. And that could be because it's a uniquely risky investment. It could be because the geography is uniquely risky. It could be because the operations are uniquely risky. And the insurance carrier just doesn't have a plan that can adequately price that risk. Now, what that means is that once there are a certain amount of insurance carriers that elect to not provide insurance for this buyer or risk, then that can go into the excess and surplus markets, where excess and surplus carriers are typically and historically have been not admitted, were able to utilize no filed form rates to price the actual policy at a rate that would allow them to make money based on the risk. Now, what this essentially comes with is generally going to be higher rates. It's going to mean tighter coverages. It's also going to mean stamping and surplus lines tax. That can generally boost up the cost. What also plays a part in this is that typically this all needs to be paid up front. So that means there is no option around the payment plan like a direct admitted carrier. So all the dollars actually either have to be financed or they have to be paid up front. And then finally, you really want to look at what is the difference between an admitted carrier and a non-admitted carrier. Now, outside of just the filed plans being approved by the state and having that paper or that plan be very, very structured in terms of the debits and credits that are utilized and the rates towards a premium for a risk, it also means that it is backed by the state guarantee fund. So that means if there is ever an issue with that insurance carrier and for some reason they become illiquid and they are not able to pay any of their insurance claims, that means that the state fund, guarantee fund, will step in and provide coverage for that carrier to pay off that claim, as opposed to not admitted carriers where the state fund, if that company is to go out of business or becomes illiquid, then that means that state fund will not step in and provide insurance coverage.
Is the lack of insurance being provided to communities of color tantamount to redlining?
Personally, dealing with a lot of buyers that work in and provide housing in metro areas where often the crime scores are higher, maybe there's a larger concentration of people of color or BIPOC professionals. I think what we've started to see is that insurance carriers are being much more particular around who provides general liability and property insurance for older apartment buildings in neighborhoods with larger crime scores. Now, to a lot of investors, individuals who have been in real estate before, what that kind of seems like is what historically was considered redlining, whereas agencies, or on the insurance agency side, companies would not provide insurance in certain areas based on the demographics of that area. Additionally, when you were looking at just real estate agencies or different lenders, they historically would not provide any financing for minority individuals that were looking to buy in certain neighborhoods. And that was kind of considered redlining. Now, the question is today is what we're seeing is that kind of a new form of redlining. And I think there is a little bit of truth to that. As someone who's sat on the underwriting side and someone who's actually worked on file audit and worked through the auditing process, I can tell you that to come up with rationales that are outside of, it's just affordable housing or it's low income, there are a lot of other rationales on risks that can be utilized in filed plans or in the non-admitted market to rationalize why an insurance company did not want to provide insurance for this risk. Now, even though there are several states that do not allow underwriting companies to not provide insurance to companies because of who they're serving in terms of whether it be low income or the race, that doesn't stop them from using all these other factors to kind of discriminate against the individuals who they're potentially providing insurance against. Now, inherently in the underwriting process, there's going to be some kind of discrimination because that's the necessity of underwriting, is looking at the risk reward. But what we really need to get down to is looking at the files themselves and looking for historical trends. Most of the time when we're looking at who is actually auditing the files, they're spending so much time looking at the general trends around SEC filings and regulations that there isn't really the time to look at the deeper trends around discrimination. Now, I've spent much time going through the files and looking at files, looking at pricing. Now, there's so many different factors that there's no way that they are able to discern trends like that. Now, I really think that it's critical if we're going to figure out how do we provide insurance for communities of color, that we really start to get down to the uniqueness of different general area codes and also kind of look at the inherent risks that exist so that we can figure out which ones are better risks and which ones are worse risks. Because the less data that we really have to be able to make decisions on, the more companies just kind of, group general risks together and aren't able to look at the uniqueness that exists. But I do anticipate as the files become more digitalized that insurance companies and insurance brokers are going to get much more particular about what information is being kind of filtered through. And I think legislation is going to put more pressure on insurance companies to be much more transparent around who they're providing insurance to, why they provide that insurance, and the kind of trends that go into making those decisions.
In terms of new acquisitions, what should apartment owners know about pollution?
Condos, co-ops, apartment investors, affordable housing investors, you're always going to have an exclusion on your general liability for pollution, fungi, and mold, right? And so now generally this usually just seems like an environmental policy, but when you're dealing with individuals that are living in these apartments, what this translates to an exclusion is meaning you're not going to have coverage if mold gets someone sick. And that's not just mold, but it's also Legionella. Which can really impact people's water and is something that does happen in apartments all the time. And what a lot of investors don't know is that through a pollution policy, this can be coverage that's kind of easily accessible, which will then step in and provide coverage for the property damage, potentially of the mold, but also for the lost income, the time frame that the tenant is not able to be in there, and then potentially also the damage that's caused from the health of the individual tenant. So you got a policy that has pretty broad coverage and is also just very applicable to a lot of investors.
What should real estate professionals know about site security for urban infill during a project?
Whenever we look at projects that urban infill or investing in an area that maybe has a higher than normal crime score, is going to be the Oaklands, New Yorks, Miami, Dallas, Los Angeles, right? What insurance carriers are very thoughtful about is what's the potential for arson? Because in terms of fire, like they know that yes, these buildings catch fire, but there's no real source of like gas or ignition. But what has become really prevalent is arson. And unfortunately, it happens so often that carriers have really become very strict about what kind of security needs to be on site for them to be comfortable providing insurance. Now, what that can mean from a cost standpoint is anywhere from having cameras, to having fencing, to having on-site security, to have water mitigation, sensor systems. Now, all this really adds up very quickly. And a lot of times on projects that are starting at 10 million, you probably have a cost that could be anywhere of $50,000 from a minimum up to 150,000 as you kind of move up to 15 million, 20 million, 30 million, 40 million, $50 million project. And so not only do you have your insurance costs and the builder's risk, but you have this large cost from a security standpoint as well.
Why else should you provide insurance for a new acquisition or real estate investment?
Recently, this has been brought up by legislature in several states that maybe there's a different way that affordable housing insurance can work. Some of this plays out in captive, some of this plays out in larger deductibles, some of this plays out in group captives. But what typically historically has not been thought about is looking at how to put this into an RPG or a risk purchasing group. Now, risk purchasing groups historically have been around to really step in when there was systemic issues, particularly around third-party liability suits. These are going to be the third-party liability suits that systemically are potentially going to stop an industry from being able to function and provide their services. Now, what's also very interesting about RPGs is that they're not insurance companies. They're made up of the members themselves. And that means that members are traditionally taking all the risk. Now, there can be fronting papers and there can be insurance companies that potentially sit over the main insurance, but for the most part, the risk purchasing group is taking on all the risk. Now, the reason why this has mostly been held to third-party liability is because third-party liability is frequency-based. And so you're able to make some kind of statistical analysis around what do we feel the loss pick is actually going to be. And there's less variability because we get so much data. Now, the reason why property insurance typically hasn't been utilized is because there is such a concentration risk when you look at different properties, particularly by different owners, and we think about how do we insure them together. One fire, one storm, one cataclysmic event could really cause major, major damage to not just companies themselves and how they operate and who they help, but can also severely impact the entirety of the insurance carriers and insurance business. Now, that's really why generally, insurance regulators have been against applying this to property. Now, when it comes to affordable housing, if you did it right, and there was a way for, the concentration of risk to be considered, and we tried to stay out of areas that maybe didn't have the type of historical wind or hail exposure or flood exposure, then maybe there's a way to make that work. But who knows? We'll see.
What are MOU insurance costs, and what's important to know about them?
When we look at an MOU and you're looking at buying a building, just know when you look through the finances and you look at the expenses, just know that what is on the current estimated insurance costs versus what on the estimated pro forma insurance costs at the most ideal state, there's probably only going to be a small increase of maybe 5% or maybe 7%. But this probably does not reflect reality because this policy will be underwritten. So what was $400 a door, $300 a door, based on their current expenses, that could easily end up being $750 to $1,000 per door. So you want to get ahead of that as fast as possible.
Can you tell us a little about the utilization of earthquake sprinkler leakage?
I think a lot of investors and affordable housing providers, I think they understand the concept of the risk of earthquake, right? But what they don't maybe understand is that built within their property policy, even if they don't have earthquake coverage, is potentially a coverage that's called earthquake sprinkler leakage. And this is usually a throw-in. Some carriers are particularly about it. For the most part, it's a throw-in and you can get very, very high limits. Now, when you look at and we do assessments of what the catastrophe risk is from an earthquake, we're looking at a few factors. We're looking at the original shape and the damage it does. We're looking at, the sprinklers are going to leak. There's going to be flooding from those sprinklers. What kind of damage does that do? And then we look at the fire following. There's going to be fires because there's going to be gas leaks, and that's going to cause major damage as well. So the total maximum probable loss is really those factors. But if you look at the policy that you probably have in your insurance, the normal one without earthquake coverage, you probably have a limit for EQSL. Now, this is a highly, highly important coverage Because if you do have an earthquake, it's on the Richter scale, anywhere from 5, to the 7, which we just had a 4.4, it's very likely that these sprinklers will leak and there's be major water damage. You actually can get that coverage or potentially already have that coverage, and it's decently cheap.
Thank you, Jonathan. This Beyond Insurance conversation has been beyond insightful.
Beyond Insurance, insurance that covers you beyond your needs.